Greetings and welcome to another CrashWatch video where we chart the real-time dynamics of the stock market and we look at what types of data are important to keep an eye on so that you can learn about them and form your own conclusions. This is not any investment advice. These videos exist for the purpose of just teaching people how to look at various market indicators, and these videos are meant to be useful for months and years even after they are produced, so it's not about any short-term trading or anything like that. Again, all of this is not investment advice. It's just educational material to help you make your own conclusions. Remember that. So this is the S&P 500 5-year chart. And from prior CrashWatch videos, you can see that there was a head and shoulders pattern and the market fell after that, but it didn't fall all the way down to what I think is the ultimate bottom, which is the low 3000s, partly because you just have to look at this 2017, 18, 19 trend to see where we will settle at when the distortion above trend because of COVID-19 stimulus, etc., happens to dissipate. Now, I believe quantitative easing should be permanent and be in the form of cash sent directly to people rather than the Treasury and MBS buying that the US Federal Reserve does. That's a separate topic. Therefore, I believe the ultimate bottom of the S&P 500, the most holistic US stock index, which comprises 98% of the US stock market, and which is diversified internationally because all the biggest companies have international profits as well. Usually 30, 40, 45% of the profits of the S&P 500 come from overseas. So low 3000s is where I think it will settle. And look at where we currently are. There was a brief spike, which is known as a fake out, to make people think that the stock market correction is over. But it's always a pattern of lower highs and lower lows because we have not gotten into a capitulation phase, which is a necessary aspect of a bottoming process. And we have fallen a little bit now as well. Now here's the thing. This is September. I believe the market is not approaching a fear point where a crash is going to be imminent, but I do think by October there is a chance for significantly higher downward revision. Reasons for that include more quantitative tightening progression, as well as just the dynamics between VIX futures and S&P 500 technical indicators. Now that's a lot of detail that we won't necessarily go into, but I still say the ultimate bottom is in the low 3000s, which is still not low when you look at this 2018-19 prices. So many people talk about, well, they're down 30% since the high. Yeah, but what type of high was this? Are you higher than you were in 2019? Yeah, so then don't complain. Why people like to cherry pick starting points and take short time horizons is just really quite absurd. So let me hide my face so we can talk about this chart a bit more. So when we get to the low 3000s, that isn't an unusually good entry point. The best entry point of the lifetimes of most of the people watching this here was right at the start of COVID when it went to the low 2150s. And I timestamped on Twitter that I said this was one of the best entry points you'll ever see in your lifetime. And that turned out to be true, even if it gets down to the low 3000s. But given that it's close to 4,000 today, yes, that really was an incredibly good entry point. So what are factors pressuring the S&P 500 further in addition to quantitative tightening? Well, we have the Treasury Yield. This is the US 10-year Treasury Yield, and it used to be well below 1%. It went as low as 0.58% in 2020, but now that there is tightening by the Federal Reserve, meaning they're selling back the treasuries that they were buying before, the yield is now 3.42%, which is a little high. It's very low by historical standards. Most of the last 40 years was much higher than that, but it's also at a point where the PE ratios of the S&P 500 come under pressure because the extreme share buybacks that are financed by low interest rates are not as easy to do, number one. Number two, this makes mortgage rates rise, which cause housing prices to go down. And this is something people don't understand. They believe the time to buy a house is when mortgage rates are low. No, nothing could be further from the truth. It is a two-variable equation, and the time to buy a house is when interest rates are high, and then when interest rates get low, that is when the home price rises and you have home equity and then you refinance at the lower rate. It's a two-step process because of the two-variable equation. Getting a mortgage at 3% for $1 million is the same payment as 5% for $600,000, but if you do the latter, 5% for 600,000. When the home price rises to 1 million, then you make 400,000 in that example. And people just don't understand that. That's why too many people in the United States buy when interest rates are low, because interest rates being low is a great time to buy a car, because car prices don't fluctuate based on the interest rate, but house prices do, and then people are condemned to a decade or more of negative equity. So Treasury yields are definitely an indicator pressuring the S&P 500 and the broader economy, threatening a housing bust. And unlike the housing bust of 2008, 2009, this can't go down to zero. There isn't a lot of room to boost this up. So the Federal Reserve will eventually be cornered into more expansive types of quantitative easing, meaning they can't just buy treasuries and mortgage-backed securities anymore. They're going to have to send cash directly to people. Unfortunately, they're going to do a mortgage bailout program rather than send cash to all people. Therefore, the people who were prudent enough not to buy a house are not going to be rewarded. The grasshoppers are going to be bailed out, and the ants are not going to strengthen their position despite their prudent frugality. That's a problem. So this is the 10-year yield. Now we should look at the VIX complex as well. This is the VIX Volatility Index futures. What is the VIX? It is how much people are willing to pay for put options on the S&P 500. More simply, that means the higher the VIX, the greater the fear level. The lower the VIX, the lower the fear level, but the more worried you should be, because when fear levels are too low, that's when the market punishes complacent people. And the median of the VIX is around 19 to 20 long term. So it's 27. Fear level is moderately high, but this futures complex, this blue line over here, is pretty downward curved. That means the futures complex is not in a state that predicts correction. Now, corrections can happen because of surprise shock events like 9/11, 2001, or COVID. And when things like that happen, yes, the market can fall a lot in a very short time. And then it rises also in an equally fast time as people calm down. When you talk about structural market declines for technical reasons, the VIX complex is often an indicator. And right now, it's not indicating that we're going to have a correction in the next couple of weeks. Now, after that time, things might be in a different state, but within the next 2 weeks or so, I don't see that there's going to be a substantial stock market correction in the S&P 500 just based on this, and this is one of the ways you read this. Now again, this is not investment advice. It is how to read a new tool and add that to your toolkit of figuring out what to do. So this is the VIX futures complex, and this delta of the nearest month being lower than the month after is called contango, C-O-N-T-A-N-G-O. If the nearest month were higher than the one after, that would be called backwardation. So this VIX futures complex is itself a vast subject. But anyway, this was the CrashWatch video for today, September 13th, 2022. And the interesting thing about this is how it's almost the lull before the storm. All types of dark clouds are gathering, but the Federal Reserve is at least managing the unwinding a little well, because the stock market isn't falling fast. It's declining in a very gradual way to minimize this VIX from going too high. If the VIX went to 40 or 50 or 60, that would be a state of higher fear, which causes more recessionary pessimism than a more orderly decline. Now that also means the stock market may be manipulated after all if they can control it this well, but a steady decline that takes a long time and comprises of lower highs and lower lows is still better than a gigantic rapid crash. But a decline is still a decline, because one should strip the emotion out of it and look at the charts, and that's all. But anyway, I hope you found this video to be useful, and if you like this type of content, I urge you to subscribe to this channel. Thank you very much for watching.